Hey everyone, welcome into another edition of Market Takes. Today we are breaking down the non-farm payrolls report, the jobs report for June. We're going to be taking a look at what all that is and what came out of that, telling you what to make of today's big jobs data and the big number that came out. Of course, we're going to be talking about what the number was, what that headline number was, as well as digging into the report a little bit to tell you how it compared to expectations and what it means with the fact that it exceeded or missed expectations in this case means going forward. We're also going to talk about some standout numbers in the report, some things that may have been in between the lines that you may have missed if you were just reading those headlines or, scanning what's out there. Also, of course, going to take a look and talk about the market reaction and as well as talk about the current market focus and how the market, how investors, even how the Fed is viewing this latest jobs report number. And then, of course, we're going to talk about what's next because, we're always looking forward, even though it is backwards looking data. So first things first, what the jobs report number showed. Jobs gains have really started to slow. And the report was interesting, not just for what it showed about June, but what it showed about the previous month. So I want to put a chart up here on your screen right now that just shows what we are seeing. Now, as you see there, you saw coming into 2022 and even earlier this year, big blowout numbers. But as you see there, if you go back and look at on the left-hand side of your screen there, 2018, 2019 numbers, those were pretty regularly under that 250,000 number. Well, with the revisions that we got today for both April and May, and then June's number coming in at 209,000. So we got an addition of 209,000 jobs in June with a 3.6% unemployment rate. Now, as you can see, that's getting back down to that trend that we had seen below 250K back in 2018, 2019, early 2020, of course, when the economy was still good, still strong, still growing, jobs were still being added, but not at that pace that you see through 2022 there and 21, where those were just exceeding 500,000, exceeding 750,000, at sometimes exceeding 1 million jobs added. And we've cut the screen off at that 1 million number. A lot of you may be saying, hey, wait a second, there were a lot more jobs lost in 2020, a lot more jobs gained. We've cut it off at 1 million so we can give you a good idea of the real scope of what's going on in the trend rather than just a couple of outliers. So you see there the trend is slowing down, and from the jobs report today, we saw a revision of 110,000 jobs fewer in April and May, 77,000 less jobs added in April, and 33,000 less jobs added in May. That brings those numbers down significantly from where they were and really kind of takes a lot of the steam that we had seen from these jobs report and from the trend coming into this month out of the market. So just showing you there, and this report really just illustrating the declining gains that we're seeing. Still big gains, still solid numbers, still seeing a labor market growing at a fast pace, but slowing down, cooling down, kind of doing exactly what the Federal Reserve wants to see the jobs doing. Now, this number missed by about 100,000, or sorry, this number missed by about 30,000, but it's about 100,000 less than the previous month, even after these revisions. So 209,000 jobs added in June. That was down from 309,000 added in May, according to the revision. And again, missing by about 30,000, expected to add 240,000 last month. This is the first month in over a year, actually, that the jobs gains number has missed expectations instead of exceeding expectations. We had seen 14 straight months of the jobs report actually beating expectations that economists had, and this is the first month in a long time. I want to talk about that unemployment rate because that's got a little bit of importance. It matched 3.6% rate that economists were expecting. That had been predicted by economists surveyed by Dow Jones. Unemployment rate declining for the right reasons. More good news. You got the number of unemployed people rising, going up. You got the number of people unemployed declining. And you got people out of the labor force increasing, but just by a little bit, only rising by about 50,000. So the labor force participation rate staying steady. That had been something that we talked about for a while. Still 62.6%. That is not good. That's historically low, but it's not getting lower. It's not worsening. Something to keep your eye on. Now, the trend had been coming in very strong as we came into June. We had seen 341,000 jobs added as an average per month over the last 12 months coming into the report. So those June and then the 12-month, or sorry, May, the 12-month before that, we had seen 341,000 jobs added per month. But with the revisions, we're now seeing the last 6 months. So The first 6 months of 2023, all the numbers that we have data for, the 6-month average is 278,000. That's much lower than 341. And again, exactly what the Fed wants to see. The Fed's efforts to slow the economy down, to get that soft landing, to kind of bring the plane down and give it a nice smooth landing on the runway rather than kind of crashing in, as a lot of folks have worried that we might see. So we're seeing the jobs gains slowing down rather than turning to job losses or rather than hitting zero. This is some very good news for the Federal Reserve, and this is, again, what they want when they talk about a slowdown or a soft landing. This is what folks are expecting, that 209,000 number and those revisions for April and May, really kind of showing that we are slowing down. Now, to the not so good news about the labor market, we look at average hourly earnings. I want to put a chart up here on your screen, those average hourly earnings numbers. And as you see there, you see going back into 2022, this declining trend. You see a couple of months pick up, but overall we're moving lower. What we did see this month, though, was average hourly earnings pick up to 4.4% year over year. And that was expected to decline to 4.2% after last month's 4.3%. But as you see up there on your screen, that instead picked up. It's just a little pickup. And again, 1 month a trend does not make. This trend is still looking pretty smooth, looking like it's moving in the right direction for the Federal Reserve, not moving in the right direction for folks like you and me who are trying to get paid a little more, get those raises at work. But in terms of what the Federal Reserve wants and in terms of what's going to be good in their minds for the economy, they don't want wages to rise too much. They don't want earnings to increase too much and to be rising at that fast pace like they were there towards the middle of 2020, and even really as we got into 2021 and 2022, they want it to slow back down to the numbers you see in 2018, 2019, right around that 2 or 3% range. That's what signals a healthy economy in the Federal Reserve's mind, and we are still well above that. So this chart is really illustrating how we remain above where the Federal Reserve would like us to be on average hourly earnings. And this month, in June actually, you saw average hourly earnings pick up even though they were expected to decline. Some other not so great numbers while we're looking at, we looked at the bright side, now we're going to look at the dark side a little bit. Leisure and hospitality, which had been the strongest job growth engine over the past 3 years, added just 21,000 jobs. That's a pretty anemic gain in leisure and hospitality, but if you want to look on the bright side of that number, it shows that maybe leisure and hospitality isn't adding all of the gains for the month. That's potentially a positive thing, but we are seeing a slowdown, and really the thing that had powered the jobs growth economy for a long time, really for the past few years, because a lot of those folks were the first to get fired, lost their jobs. For a long time, leisure and hospitality jobs still had not come back. We're still below the level that we were at the end of 2019. So again, that slowdown in leisure hospitality suggests maybe the job gains are more widespread, more even, but it also suggests that engine that had been powering us higher is starting to slow down. The retail sector lost 11,000 jobs in June. Transportation and warehousing saw a decline of 7,000 jobs. So we are seeing some sectors that are really showing weakness in that retail sector. Transportation, warehousing, those manufacturing jobs have been showing some consistent weakness for a while. Last thing I want to point out to you about this jobs report in terms of some of the negative news, the number of people employed part-time instead of full-time, people who are employed part-time instead of full-time for economic reasons, that number jumped to the highest since May of 2022. So you want to keep an eye on that, because that's kind of one of the first signs of, things are not getting so great, is people, instead of laying folks off, instead of firing people, instead of doing that, they sort of cut their hours and say, hey, look, I can only give you part-time hours this week. That number rising. 1 month does not a trend make, but we did see an increase to the highest number, 4.2 million in June. That's the highest since May of 2022. We'll read you just a real quick quote from the BLS report, the jobs report. Quote, the number of persons employed part-time for economic reasons increased by 452,000 to 4.2 million in June, partially reflecting an increase in the number of persons whose hours were cut due to slack work or business conditions. As there's not enough work, there's not enough business coming in, we're gonna have to cut your hours. Persons employed part-time for economic reasons are individuals who would have preferred full-time employment but were working part-time jobs because their hours had been reduced or they were unable to find full-time jobs. So these are not necessarily good things. That increase not a good thing. You'll definitely want to watch that going forward. So how does this relate to inflation, growth expectations, all those things that we are expecting for the rest of the year? Well, this is showing that the market is slowing down, that maybe the Fed won't have to do as much. I doubt that this will change the expectations for July. July. The Fed funds futures market still very much pricing in a Fed rate increase. Later this month at the Fed's July 25th, 26th meeting, that the Fed is going to raise rates by 25 basis points. Doubt that this will throw them off, but the Fed has said and telegraphed that they expect to raise rates 2 more times this year. We may only just get 1 more rate increase, and certainly this report does not suggest they will have to do more than that. And that's a good thing, again, for the overall growth of the economy, because, you know, when the Fed chokes things off, the more they have to do, the higher they have to raise rates, the less the economy is able to really grow and flourish, and less people are able to add more jobs, things like that. Fed is trying to get inflation under control with prices rising, with businesses booming, with folks going out and spending money. That just pushes prices up and up and up, and the Fed wants to slow that down. So the less they have to do, the more businesses can flourish, the more business people can flourish, the more people can get jobs, et cetera, et cetera. This is a pretty good sign, today's report, and it suggests that the Fed could be interpreting it as, okay, maybe what we're doing is starting to work on the labor market front. It's getting us towards that soft landing that Fed Chair Jerome Powell has really laid out and said he believes can still happen. We could be getting there. Now, let's check out the market, and want to throw up here on your screen just what we are seeing from the market today. Got the bonds up there right now. Want to show you just a big pickup. Now, you see there the 2-year note. You see a big decline in yields and then a pickup, and then we've come back down again. And that's really kind of the same thing you're seeing across bonds. You know, when you look at the 10-year, you see a sort of similar kind of motion. When you look at the 30-year, a similar kind of thing. After that jobs report came out, you see the yield go down, and then you see it pop back up. And now we're kind of coming back in. It seems like investors are really digesting these numbers and making some different decisions than they did right after the report came out. You're seeing stocks starting to pick back up. You see the NASDAQ here really taken off after that report came out and after the market opened, 9:30. But then now we're coming back down a little bit. Same thing on the S&P 500. That jumped up and got positive, now coming back down a little bit. As you look at commodities here, I think what's interesting is you see crude futures pick up, again, right around that 8 p.m. or that 8:30 time frame. You just see a real takeoff, and that could be because a lot of worries were in the market about, man, if this jobs growth thing keeps taking off, more work from the Fed, slowing down the economy. Well, you see a big reaction from crude oil right there. Also an interesting reaction from gold, I think. You're seeing a pickup there, and that's interesting. So really the market just illustrating right now that there's a lot to watch and a lot to think about when it comes to this jobs report. Not too great, but not too bad either. There are some things on both sides that you could worry about, some things that you could be excited about from this report. Last thing, let's talk about the current market focus and why the market is thinking about the jobs report the way that it is. The market narrative has really shifted to bullish over the past couple months. When we did see that big number for job growth in May that was released last month, the market really actually reacted strongly, reacted positively, because the expectation was, okay, well, this isn't going to really change what the Fed's going to do. The Fed made clear, hey, they're going to raise rates 2 more times this year. That's what they expect. But even that didn't deter the market. So we have seen a strong bullishness. We've seen stocks really pick back up over the past month or so. And we've seen that kind of go away over the past couple days. But remember, a couple days does not make a trend. What we've seen over the past month has been a concerted move higher in the market, driven a lot by tech, but it's been a much more broad-based rally. This report really kind of backs that bullish narrative. It suggests, okay, the jobs numbers are cooling off, but we are still seeing higher than historical averages in terms of job growth. The economy is still moving forward. That ADP jobs number that we got earlier this week suggested the labor market might be a little hotter than this jobs report is backing right now, but we are still seeing some solid numbers in terms of the labor market. And we are also seeing that perhaps the Fed's policies are having the intended effect and doing what the Fed hopes that they will do. This one really, again, the one number you might want to watch out for if you're saying, yeah, but, is that average hourly earnings number. Average hourly earnings unexpectedly picking up and rising when they were expected to decline. Keep your eye on that. That'll be one to watch next month. If it again resumes that trend of moving lower, okay, nothing to worry about. We're still on the right course. If it picks up again, though, that could be something that you'll want to keep your eye on, and maybe something that can move the market when we get this report next month. One last thing I want to put up here on your screen is the number that we've seen that the Fed chairman has referenced a number of times. So I want to put this chart up here on your screen right now, and that's the number of unemployed people versus the number of job openings. Fed Chair Jerome Powell has said a number of times that this reflects an out-of-whack labor market, a labor market that's too hot, that's unsustainable. And what he's talking about is, you see that red number, that's the number of job openings. This is the number of people the number of job opportunities there are out there, a number of people that are trying to hire. They want to hire that many people, but there are only the blue number, or the blue line there, number of people who are unemployed. So there's just what Fed Chair Jerome Powell has described as a mismatch in terms of what the economy is looking for, in terms of what's available. And that's going to drive those hourly earnings up, which in the Fed's mind is going to drive inflation up. We know that corporate profits have been a big part of what's driven inflation, but wages have also been a part of that. And when the Fed thinks about it and when they talk about it, they have only talked about wages. They've only talked about job gains and growth in terms of that part of the economy. And this is what they're looking at when they talk about the job market being a little out of whack. You see that red number well above that blue, or that red line, excuse me, well above that blue line. It's not really coming down. You're seeing job openings decline a little bit, but that pace is very anemic. It's very slow, as you see. And that chart just illustrating that labor market is not coming back into equilibrium the way the Fed would like just yet. We did see a slight decline, 9.8 million job openings instead of 10.3 million the previous month, lower than the expectation. But the quits rate also strong, showing that, again, people still have confidence in the labor market. We saw a number of other things. The ISM services number, that was stronger than expected, highest in 4 months. But we haven't seen a big we haven't seen a big takeoff in any of these numbers or expectations. So we are just seeing a continued strength in the labor market that's not too strong. Also, that Challenger job cuts report that came out a little earlier this week, I think it was yesterday, dropped to about 40,000 layoffs for the previous month. That was half of the month before. So, all suggests that the economy is moving in the right direction. We're seeing layoffs kind of increase more than they were in 2022, but maybe that's a good thing in terms of the equilibrium of the jobs market. Nothing really suggesting that things are out of whack or getting out of control. All right, so that's what we've got for the jobs report today. When you make of the jobs report, you say, hey, things are moving the way the Federal Reserve wants them to. Jobs growth is still continuing. People are getting hired, they're getting jobs, but it's slowing down from that very rapid pace we saw in 2022. Things are coming down and moving towards that soft landing that Fed Chair Jerome Powell has talked about. That's really what you can take away from this jobs report. The market kind of responding accordingly. There has been a lot of big pickup in terms of stock prices and in terms of bond yields, and some of that kind of cooling off. Okay, this might be a little bit of buy the rumor, sell the news, or buy the rumor, don't buy the news again. We aren't seeing a lot of big reaction from the market. And I think that could be because this just sort of reinforces the narrative that's already been there in the market for a while. Here's what comes next. We are on Monday. We'll be right back here on Market Takes, previewing the week to come. It is a big week. We've got inflation coming out. The CPI report, the CPI inflation report is out on Wednesday. Also get consumer credit, small business optimism, the Fed's beige book. But we will be talking to you about the Amazon Prime Day holiday that's coming up and how that could be reflective of what the economy is telling us, what consumers are doing. I'll break all that down, as well as some big bank earnings coming out later that week. We'll be breaking all that down here on Market Takes Monday morning. So listen, be here or be that's a square. Don't do it. I'm Dion Rabowen, reporter at the Wall Street Journal. That's going to do it for us here on Market Takes. Hope to see you next time.